Have you taken your required minimum distribution yet for this year? It's time, and there's a stiff penalty if you fail to do so. I'm going to explain that, give you some tips to help you take your RMD this year. I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Required minimum distribution, RMD. This is once you turn age 72 and you've got pre-tax retirement accounts, the government says, I don't care how much you take out, but you've got to take out at least this much. You're required to take out at least a minimum amount of that IRA, okay, or pre-tax retirement account. By the way, same thing applies. You've got to take this required minimum distribution if you have a pre-tax account that you've inherited from someone other than your spouse, okay? That's a topic for a different video. I've done plenty of videos on that. But this is a reminder and some tips, some warnings about, hey, how you can do this well, to take a required amount out, that minimum amount out from your pre-tax retirement account once you turn age 72. Now, it used to be age 70 and a half. I have no idea why. We stopped counting half birthdays when you were 3, maybe 4, depending, if you're trying to get some extra presents. But why 70 and a half? I have no idea. Thankfully, they changed it to age 72. There's legislation out right now trying to push that to age 75. We'll see. I hope that passes, give you more flexibility. Now, if you are already drawing enough out of your IRA and pre-tax retirement accounts to supplement your Social Security, your other retirement income needs, where you are already taking out well above that minimum amount, then great. No problem. Then you're good. There isn't anything you need to, pay attention to some of these tips. Maybe you could do it better, but then this really doesn't apply. It's a non-event. But for those of you that have enough retirement income and you don't need to draw off of your IRA, or you haven't been, or you're supplementing your retirement income from other sources, and you're just leaving this IRA alone, your pre-tax account, then you've got to pay attention, because every year you're required, once you turn age 72 and thereafter, the IRS says you've delayed taxes on this money long enough. You never pay tax on this, and all the growth you've never paid tax. It's time for you to at least draw some amount out and report it as taxable income. That's your required minimum distribution. And you've got to take it out by 12/31 every single year. And if you don't, it's a stiff penalty. It's a 50% tax penalty. And you still have to report the income as taxable. So very, very stiff penalty here. You're not going to want to skip it or miss it, okay? So what are some tips to help you take your required minimum distribution and take it effectively? Well, the first tip is make sure you calculate exactly what that required minimum amount is every single year. It changes every single year. You take the value of your pre-tax retirement account on 12/31 of the previous year, and then you divide that by your life expectancy from the uniform life insurance or life expectancy tables. Okay, so it's an actual calculation based off of what the value of your account was on 12/31. So that's obviously going to change every single year. Your value is going to be a little bit different on 12/31. Also, you're 1 year older. So in that uniform life table, it's life expectancy table, you're going to be 1 year older. But then in addition to that, this year, 2022, they actually expanded these uniform life expectancy tables. So without you doing anything, the required amount that you needed to take out reduced a little bit. That calculation got a little bit better because they've changed these life expectancy tables. So tip number 1, make sure you calculate what your required minimum distribution is each year. Don't just assume, well, this is what I did last year, I'll do the same thing this year. Calculate it. Last year, if it was $16,000, don't just say, I'll take another 16 out. It's fine. I'm sure that covers it. No, calculate it. It might be that, $14,201. And if once you know that, you can say, yeah, just take 16. That's what I did last year. Okay, great. But if you're doing the required minimum amount and not $1 more, or really right at that number, calculate it, you're going to want to do so every single year. Second tip is if you're also donating to a nonprofit, to a charity, you can actually donate some of your required minimum distribution, or all of it, to that qualifying charity as a qualifying charitable distribution. And none of that money that went from your IRA to the charity, none of it will show up as taxable income on your tax return. That's a fantastic way to do some tax planning here. Instead, if you have to take this required distribution out and then you're also making a donation to the charity, you're having to report this income on your tax return, and then most likely you're not getting a tax benefit for that donation because most people aren't itemizing their taxes anymore. Instead, how you do this qualified charitable distribution is the money needs to come directly from your pre-tax retirement account, from your IRA. I don't believe you can do a qualified charitable distribution from a 401k or 403b. I'm pretty sure that is the rule. I didn't look that up and confirm it before the video. I'm pretty sure that's the case. But so from your IRA, the money's got to go directly to that qualifying nonprofit. Directly from your IRA to that qualifying nonprofit. If so, then it will count towards your required minimum distribution, money left, and it's for a qualifying reason, but it won't land on your tax return. It won't land as taxable because that money went directly to the charity. So if you are at this required minimum distribution age and you're donating money, whether to the church or whatever, on each year, consider doing a qualifying charitable distribution, sending money directly. You can even do it once each month, right? Instead of once a year. It's directly from your pre-tax retirement account, directly from your IRA to that nonprofit as a qualifying charitable distribution. Third, if you are at required minimum distribution age and want to do a Roth conversion, you cannot do a Roth conversion of your required minimum distribution. But you can still do a Roth conversion above and beyond your RMD. So here's how that works. First, if you are at RMD age and you're doing your tax planning with your CFP and it makes sense, yeah, I still want to do a Roth conversion. Take your required minimum distribution out first. Maybe withhold it for taxes to cover the taxes on your Roth conversion. So take your RMD out first, and then you can do a Roth conversion above and beyond that. This comes up all the time. People ask this question all the time. Hey, I'm forced to take this money out of my IRA. I don't really need it. Let's move it to that Roth. Can't do it. Can't do it. You're not allowed to do a Roth conversion of your RMD, but you still can do a Roth conversion. You've just got to take your RMD out first, okay? And that parlays into the fourth tip. The fourth tip with your RMD is consider using your RMD to cover your taxes, to do your tax withholding, all of your tax withholding. Say your Social Security is taxable, you've got some other pension income that's taxable, you've got capital gains, dividends, that sort of stuff that's all taxable. And instead of doing quarterly estimates, because no one wants to do those, you forecast, here's what my tax return is going to look like, here's how much my taxes will be, and therefore I'll just withhold all those taxes when I take my required minimum distribution. Okay? For example, if you do that tax planning right now with your CFP in the fall, we're doing this all the time for folks, and look and say, yep, your taxes, you're going to owe about 15 grand in taxes. If your required minimum distribution is 25,000, then withhold 15 grand from that 25 and you're all set. You don't need to do quarterly estimates. You've covered all your taxes via withholding, so you're just fine. And you used your RMD towards that purpose. Now, if you parlay that with that Roth conversion, doing this, you do that tax analysis, include the Roth conversion, say, all right, what are our taxes going to be? Well, by doing the Roth conversion, your total taxes, instead of being 15 grand, will be 25 grand. Great. I'll convert that money and not withhold any tax, and I'll take my required minimum distribution, which I'm going to do first, by the way, and withhold all of that to taxes to cover the taxes. Now, I basically used my required minimum distribution to cover the taxes on my Roth conversion that are dollars that will eventually rebound and recover and be able to grow for the rest of your life, maybe your kids as well for their life. So fantastic opportunity. Fourth tip, use your required minimum distribution to cover tax withholdings. And then the fifth tip, the final one, last one we're going to hit for today, is actually a video that I've done in the past, and I would refer you to that video. But this final tip is make sure you're aware of the rules with required minimum distribution if you have multiple pre-tax retirement accounts. It's unique. Make sure you don't make a mistake. If you have multiple IRAs, fantastic. That's going to be easy. But if you have an old 401k and IRAs, that's unique. If you have multiple old 401ks and IRAs, that's different. Make sure you understand how that works. If you have an old 403b or multiple 403bs, that works even differently. So check out this video for more content on that, but make sure you understand those rules if that applies to you and you have multiple pre-tax accounts. Work with your certified financial planner. The big idea, don't forget doing your required minimum distribution, but then do your required minimum distribution in context to your tax planning and your proactive financial planning as well. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.